Let me show you something that happened on Friday, April 10th, 2026, that most silver investors saw as a routine price correction, but that experienced commodity market analysts recognized as something fundamentally different. Silver opened Friday morning at approximately $75.33. By the time CPI data dropped at 8:30 a.m. Eastern, March inflation confirmed at 3.3% year over year, the hottest reading since May 2024, silver had already been under pressure in the pre-market session. Then CPI printed. The number was complicated. Headline inflation at 3.3% with a 0.9% monthly surge, the steepest monthly jump since June 2022, should have been catastrophic for silver. Hot inflation means the Fed cannot cut. Fed cannot cut means elevated real yields. Elevated real yields mean non-yielding assets like silver get sold. The playbook says silver should have crashed hard on a 3.3% CPI print. Instead, silver held. It closed the week at $75.60 per ounce, posting its third consecutive weekly gain of over 4%. And then something interesting happened in the final hour of Friday's trading session that almost nobody is talking about this Saturday morning, April 11th, 2026. A concentrated wave of selling pressure hit silver in the last 45 minutes before the weekly close, pushing it from intraday highs near $76.98 back toward the $75.60 close. A 1.38 decline in 45 minutes on above average volume at exactly the moment when most retail participants had already logged off for the weekend, and institutional desks were winding down position books before their own weekend departures. That final hour move was not a correction. It was not profit-taking by retail investors who bought the CPI dip. It was a deliberate, coordinated, mechanically executed reduction in silver's weekly close price by entities who had specific reasons to want silver closing lower going into the weekend binary event of Islamabad talks. And I am going to prove that to you using nothing but publicly available data, documented market mechanics, and the historical fingerprints of identical operations that have occurred repeatedly in silver's modern trading history. Let me start with the definition of an attack versus a correction in commodity markets, because understanding the distinction is the foundation of everything else I'm going to show you. A correction is a price decline driven by genuine changes in supply-demand fundamentals or macro variables. If CPI had printed at 4.5% on Friday instead of 3.3%, silver falling $5 would be a correction. The fundamental investment thesis for silver, built on Fed rate cut expectations and dollar weakness, would have been genuinely damaged by a 4.5% print. Sellers reducing exposure in response to changed fundamentals is price discovery. That is the market working correctly. An attack is a price decline executed through paper market mechanics that is disconnected from and contradicts the actual fundamental picture. It uses the leverage inherent in futures markets, the opacity of over-the-counter silver derivatives, and the concentration of large positions to move paper prices below what physical market demand would otherwise support. The fingerprints of an attack are specific and identifiable: concentrated selling volume in thin liquidity windows, price moves that contradict simultaneous physical market data, and price patterns that set up favorable entry points for the attacking entity. Friday's final hour silver move contained all three fingerprints. Let me show you each one. Fingerprint 1, concentrated selling in thin liquidity. The final 45 minutes of Friday's trading session, specifically from 3:15 p.m. to 4 p.m. Eastern, are the thinnest liquidity window of the entire trading week. Market makers are reducing their books before the weekend. Algorithmic systems are reducing position size ahead of 60-plus hours of geopolitical risk. Retail participants have mostly stopped watching screens. The bid-ask spreads on silver futures widen as market depth decreases. This is the ideal window to execute a large sell order with maximum price impact per dollar of selling pressure. In normal liquidity conditions, a sell order of 2,000 silver futures contracts, representing 10 million ounces worth of selling pressure, might move the silver price 0.40 to $0.50 per ounce, because there are enough buyers on the other side to absorb the order gradually. In the thin, final hour liquidity of a Friday afternoon before a binary weekend event, the same 2,000 contract sell order can move the price $1.0 to $1.50 per ounce, because the buyers who would normally absorb it have already reduced their participation. The 1.38 decline in silver's final 45 minutes Friday, from near $76.98 to the $75.60 close, is entirely consistent with concentrated selling into thin liquidity designed to maximize price impact per contract sold. This is not speculation. This is the documented mechanics of how large orders interact with thin order books. Fingerprint 2, price moves that contradict simultaneous physical market data. Here is the most damning evidence that Friday's final hour move was not a genuine correction. while paper silver was being pushed lower in New York's final trading hour Friday. April 10th, physical silver in Shanghai was still trading at a 12% to 13% premium over COMEX spot. Not 5%, not 8%, 12 to 13%. Physical buyers in Asia were simultaneously paying in approximately $84 to $85 per ounce to get real silver, while paper silver in New York was being pushed down toward $75.60. The divergence between paper price declining and physical premiums holding elevated is the clearest possible signal that the paper sell-off was not driven by genuine reduction in silver demand. If silver was being sold because it was fundamentally overvalued at $76, Asian buyers would not be simultaneously paying $84 to $85 for the same ounce. Physical market premiums reflect real-world scarcity and genuine demand. Paper market price reflects the leverage and concentration of futures positions. When these two signals point in opposite directions, physical premium holding at 12% while paper price falls, the physical market is telling the truth and the paper market is being manipulated. This divergence has been persistent for months. At the January peak, when paper silver hit 121.67, Shanghai wholesale silver was trading at a $36.22 premium, 45.8% above COMEX spot. The physical buyers were already paying $157 per ounce equivalent for real metal, while COMEX said $121. The divergence today at 12% to 13% is smaller in absolute terms, but structurally identical in meaning. Physical reality is $84 to $85. Paper price is $75.60. The gap represents the ongoing attack on paper prices that has been running since January's all-time high. Fingerprint 3, price patterns that set up favorable entry points for the attacking entity. This is where the strategic logic of Friday's attack becomes clear. The entities responsible for the final hour selling on Friday had a specific objective beyond simply pushing the price lower. They needed silver to close the week at a specific level, low enough to create weekend uncertainty and potential panic selling among retail holders, but not so low as to trigger physical delivery demands or squeeze dynamics that would work against the attackers. By pushing silver from near $77 back to $75 or $60 at Friday's close, the attackers accomplished several things simultaneously. They prevented silver from establishing a weekly close above the critical $77.73 descending trendline resistance, which would have been a technical breakout signal that triggers automated buying from trend-following algorithmic systems. They created a weekly close that still shows a gain of 4%, which prevents the kind of panic selling that a down week would have produced, while simultaneously keeping silver below the technical level that would confirm the bull trend resumption. They established the conditions for a volatile Monday open, regardless of Islamabad outcome, because silver is now sitting just below the critical 77.73 level that determines whether the technical breakout happens or fails. If Islamabad succeeds, the attacking entity can cover its short positions profitably as silver rallies through 77.73. If Islamabad fails, the attacking entity benefits from the gap down their pre-positioned short exposure captures. They position themselves to profit from either binary outcome. That is not correction mechanics. That is strategic attack mechanics. Now, let me give you the historical context that proves this is not a one-time event, but a documented, recurring pattern in silver markets. The most thoroughly documented case of silver market attack occurred between 2008 and 2016, when J.P. Morgan Chase engaged in what the Department of Justice ultimately characterized as a years-long spoofing and manipulation scheme in precious metals futures markets. J.P. Morgan traders were convicted of conspiracy, wire fraud, and commodities fraud. The firm paid $1.27 billion in fines and penalties, one of the largest commodity market manipulation settlements in history. The technique they used was specific: place large visible sell orders in the silver futures market to signal bearish pressure, causing other participants to sell in anticipation of the decline, then cancel those orders and buy silver at the lower prices created by their own false sell signal. This is spoofing, the use of paper market orders not intended to execute, but intended to manipulate price. It works because silver's paper market is leveraged 7.5 to 1 against registered physical inventory, meaning paper selling pressure is amplified dramatically relative to actual physical silver changing hands. The JPM scheme ran for years before it was detected, prosecuted, and resolved. Do you know what happened to J.P. Morgan's silver market position after they resolved the manipulation charges in 2020? They flipped from their massive short position, which had suppressed silver prices for years, to a massive long position. They are now the largest single holder of COMEX silver futures, controlling approximately 40% of all contracts, and holding an estimated 750 million ounces in various silver instruments. The same institution convicted of attacking silver from the short side is now the largest single bull in silver markets. They know better than anyone how paper attacks work, because they executed them for years. And now their financial interest is in allowing silver's structural bull case to play out, which means future attacks are more likely to come from other institutions seeking to establish long positions at discounted prices, rather than from JP Morgan seeking to suppress prices indefinitely. Here is the 2026 attack timeline that puts Friday's final hour move in full historical context. The attacks on silver in 2026 have been sequential, documented, and follow a consistent pattern. Attack 1, January 30th, 2026. Silver had just hit its all-time high of 121.67 the previous day. CME Group raised margin requirements, not a market force, but a regulatory decision by exchange operators who are themselves institutional participants. The margin hike forced leveraged longs to liquidate. Silver fell 17% in a single session, the worst single-day decline since 2013. The entities who had pre-positioned short exposure before the margin hike announcement profited from every point of the 17% decline. Who knew the margin hike was coming before the announcement? The CME Group's own participants, the major clearinghouse members who are simultaneously the largest trading entities. Attack 2, February 28th, 2026. The Iran war provided geopolitical cover for a sustained attack on silver from $117 down to the March 23rd low of $61.76. The war was real. The fundamental impact on inflation expectations was real. But the speed and severity of the decline, up 47% in 23 trading days from near all-time high levels, exceeded what fundamental analysis alone justifies. Oil rising from $85 to $111 does not mathematically produce a 47% silver decline. The paper market attack amplified a genuine fundamental headwind into a historically unprecedented speed of decline that created optimal accumulation conditions for physical buyers in Asia who were simultaneously buying at the exact lows. Attack 3, March 18th, 2026. The FOMC meeting produced a hawkish statement. Silver crashed from $80 towards $73 in a single session. The selling was disproportionate to the actual Fed statement, which simply confirmed the single rate cut projection the market had already priced. The attack used the Fed statement as cover for paper selling that pushed silver below critical support levels, triggering retail stop losses that amplified the move. Attack 4, Friday, April 10th, 2026, final trading hour. Silver pushed back from near $77 to $75.60 in 45 minutes on thin liquidity to prevent the weekly close above $77.73 that would have confirmed the technical breakout from the 3-month downtrend. Each attack in the sequence has the same fingerprints: concentrated selling in thin liquidity windows, price movement disproportionate to the fundamental catalyst, and price targets that set up favorable entry or exit for the attacking entity rather than reflecting fair value discovery. Here is what the attack pattern means specifically for silver's trajectory going into Monday, April 14th and the week ahead. The attacks have been consistently used to create lower prices that serve as accumulation opportunities for physical buyers. Every sustained paper market attack in silver's modern history has eventually been followed by a physical market reality check, where the divergence between paper price and physical premium becomes large enough that new paper shorts cannot be established without risking delivery calls that cannot be met. We saw this mechanism play out in January when the paper price attack from $121 was immediately accompanied by Shanghai premiums expanding to $36.22, a 45.8% divergence that forced paper prices back upward when enough contract holders demanded delivery. The current 12% to 13% Shanghai premium is smaller but structurally identical, a persistent signal that physical buyers value silver $9 to $10 higher per ounce than paper markets currently reflect. The COMEX delivery clock makes this physical reality check even more imminent. May first notice, day is just 8 days from Monday, April 14th, based on December 2025's record 65 million ounce delivery month, and January 2026's 49.4 million ounce delivery, 7 times the historical January average. May delivery demand could easily exceed 40 to 50 million ounces. Against a registered inventory of 76 million ounces with a 7.5 to 1 paper to physical ratio, May delivery season is the moment when the paper attack infrastructure runs into the mathematical wall of physical reality. Paper attacks work when delivery demand is low enough that attackers can maintain the fiction that their paper claims are backed by real metal. When delivery demand rises to 60% or 70% registered inventory in a single month, the fiction becomes impossible to maintain. The exchange must either raise margins to reduce delivery demand or face the first genuine delivery constraint in modern COMEX history. Both outcomes accelerate rather than extend the physical premium expansion that is already telling you silver is undervalued at $75.60. Here's the data that tells you what comes after the attack period in silver's historical record. After the 2011 silver peak at $49.84 and the subsequent CME-driven margin hike attack that pushed silver from $49 to below $30, a 40% decline similar in character to 2026's $121 to $61 decline, silver spent approximately 18 months consolidating before resuming the secular bull trend. The consolidation was characterized by repeated attacks that kept silver in a range, while physical accumulation continued at depressed prices. Then, the physical accumulation reached a tipping point. Above-ground stocks became genuinely constrained, and the paper attacks became impossible to sustain because delivery calls started exceeding registered inventory. The breakout from the consolidation range was violent and fast. Months of compressed price action released in weeks of explosive upward movement. The current 2026 setup shows identical structural characteristics. Silver consolidated between the March 23rd low of $61.76 and the current $75.60 area, a range that has absorbed retail selling, allowed physical accumulation, and rebuilt a base from which the next leg can launch. The 12% to 13% Shanghai premium is the most recent signal that physical accumulation is reaching a tipping point. When Shanghai premium was elevated before the January spike, it preceded a move from $72 to $121. The current Shanghai premium at 12% to 13%, elevated and persistent, suggests the next significant upward move is being built beneath the surface, while paper attacks keep price in the consolidation range. Here is what you do with this information on Saturday, April 11th, 2026. Recognize that Friday's final hour decline from near $77 to $75.60 was not a fundamental correction, but a tactical attack designed to prevent the weekly breakout above $77.73 and set up the attacking entities for either scenario in Monday's binary Islamabad outcome. Do not sell your physical silver in response to a paper attack. Physical silver at $75.60 is being physically valued at $84 to $85 in Shanghai simultaneously. Your physical holdings are worth more than the paper price suggests. Do not let paper market attacks on Friday afternoon determine the value of metal sitting in your physical possession. For paper position holders, understand that attacks create entry opportunities, not exit signals. The pattern since January shows that each paper attack has been followed by physical accumulation that eventually pulls paper prices higher. If Monday's open produces a gap down on Islamabad failure, the attack will be followed by the same physical buying that has followed every previous attack in 2026. Watch for Shanghai premium to expand above 15% as confirmation that physical buyers are absorbing the Monday paper attack. That is your signal that the attack is exhausted and the recovery begins. The reality check for this Saturday is simple. Silver at $75.60 on paper. Silver at $84 to $85 in physical reality. The gap between those two prices is not a market inefficiency that will persist indefinitely. It is the attack's footprint, temporary, structural, and ultimately self-defeating against the backdrop of a 6-year supply deficit, 820 million ounce cumulative shortfall, COMEX delivery pressure with 8 days to May 1st notice, and sovereign accumulation that removes physical silver from the market permanently. The attack will fail. It always does. The only question is whether you understand what it is before Monday's open or after.